Picture this. You spot the perfect setup. You press buys, but before your order even fills, price shoots up without you. Annoying, right? That's lack of liquidity. Now, what is liquidity? Think of liquidity as how easily and quickly you can get in or out of a trade without pushing the price around too much. In simple trader's language, it's the pool of pending orders sitting in the market, like buy side and sell side stop loss orders waiting to get triggered. When a market is highly liquid, there are plenty of buyers and sellers at every price level. Your orders fill fast and prices stay stable. But if the market's illiquid, it's like trying to sell your car in the middle of nowhere. You'll have to wait for someone to show up, and you might end up giving a discount just to get it sold. In trading, that discount comes in the form of wider spreads, slow execution, slippage. Now, how do we use liquidity to our advantage? There's a saying, if you don't know where the liquidity is, you are the liquidity. So how do we spot it? Liquidity can rest anywhere. But the obvious liquidity is what the market goes for most often. That's the stop sitting just above swing highs or just below swing lows. That's the order stacked around clean support and resistance zones. Our job as traders? Don't get caught with the crowd. Instead, watch where that crowd stops are, because those are the exact levels the market loves to tag before making its real move. Now that you get the basics of liquidity, it's time to break down all the different types, starting off with understanding BSL and SSL. BSL stands for buy-side liquidity, which refers to the stop orders of short sellers, and SSL stands for sell-side liquidity, which refers to the stop orders of buyers. Next comes dealing range liquidity. But what exactly is a dealing range? When price is moving inside a range, the short-term high and low form the dealing range. There are stops above and below it, and price often sweeps those stops and reverses. A dealing range is basically the same as external range liquidity, just different terms that confuse people. But if you zoom out, that same external range liquidity often becomes internal range liquidity within a larger range. This then brings us to internal range liquidity. Internal range liquidity is the liquidity that builds up inside a range, not at its outer highs or lows. It forms when day traders or scalpers place stops above minor highs and below minor lows. For example, what looks like internal liquidity on a 5-minute chart might actually be part of a larger dealing range on the 1-hour chart. Smart money uses this multi-time frame setup to collect liquidity before moving price in the real direction. Next comes relatively equal highs and lows. Relatively equal highs and lows are points on a chart where price forms similar highs or lows, creating the illusion of strong resistance or support. For example, when price touches the same high level multiple times, traders see it as resistance and expect a reversal. The same goes for equal lows acting as support. But in reality, these levels build up liquidity, since traders place stop orders just above equal highs and below equal lows. Smart money often uses these areas to engineer liquidity grabs, pushing price slightly beyond these levels to trigger stops before reversing in the true direction. Next up, previous week high and low liquidity. The weekly candle high and low represent the highest and lowest price points of the week. Swing traders often watch these levels closely, as many place stop orders just above the weekly high or below the weekly low, creating liquidity pools. Smart money often targets these areas, sweeping those stops before reversing price in the real direction. The same idea applies to daily and monthly candle highs and lows. They all serve as major liquidity points. Next comes session liquidity. Session liquidity, also known as time-based liquidity, refers to how price moves to collect liquidity within specific trading sessions like the Asian, London, and New York sessions. Each session creates its own high and low, forming liquidity pools where traders place stop orders. When a new session opens, smart money often targets these levels. For example, the London session might take liquidity from the Asian range before moving in the opposite direction. Later, the New York session can then reverse again, taking out London's stops, as London often acts as the manipulation phase of the day. Understanding how liquidity shifts between sessions helps traders identify when and where major moves or reversals are likely to occur. And that's basically it for this video.